Wall Street legend explains how inverted bond yields implode markets. Now, U.S. Treasury bond yields have inverted across the curve, and it's one of the hottest topics to talk about, and it should be, as it's a massive indicator that's been nearly perfect for what comes next. And one of the most successful Wall Street investors of all time, Stanley Druckenmiller, has issued a dire warning for the global financial markets and potential outcomes. And with the yield curves inverting this week, and predictions of recession being announced, there couldn't be a more critical time to analyze Stan's predictions of doom. So in this video, we're going to break down the recent yield curve inversion, what it means, why you should care, why it's doing this, what history tells us about this, and of course, why Stan believes it's mathematically impossible for the US to fix things, and what this all means for the markets, and most importantly, your assets and portfolio. So let's go. All right, welcome back to the channel. If you're new, my name is Mark Moss, and I make these videos to change the way you think about money because everything you've learned is wrong. It's a big claim, I know. Almost everything you've learned. Okay, how about that? So, yeah, big news today. One of the most reliable indicators has flashed a signal, but we want to dig in and take a look at this and see what does it really mean, and is it really correct this time? Pretty interesting to see what's going on. Now, real quickly, I do want to say, if you haven't already heard, which of course I'm sure by now you have, marketdisruptorslive.com. You need to come. There's a link down below. Come hang out with me, about 15 of the top speakers in the world, Danielle DiMartino Booth, Luke Grumman, George Gammon, Jason Hartman, Robert Breedlove, Harry Dent. I could go on, but you get the point. Oh, and I got Heresy Financial. A lot of you guys watch that channel. He's coming. We're talking about Joe Brown's coming as well. It should be pretty cool. To tell you two things, what they think is going to happen in the near term and what you should be doing about it to build, grow, and protect your wealth. Come hang out, meet us, shake our hand, ask us questions, and even sit down and have dinner with us. It's going to be amazing. MarketDisruptorsLive.com. Don't get left behind on what happens this year, 2022. It's going to be dangerous if you're not paying attention, but it could be amazing if you're paying attention. All right, now back to the yield curve control. So everybody's talking about this, recent yield curve inversion. It's occurred just this week. And if you haven't heard about it yet, if you're not talking about it, then what are you even doing? Okay, but for those of you that are not watching and talking about it, are you asking yourself right now, like, what the hell is the yield curve and why should I even care? Well, over the previous 50 years, every time the yield curve has inverted, a recession has occurred in the following 6 to 18 months. Now remember, our most recent recession, the pandemic recession, as many policymakers and governments love to call it that, well, many people proclaim that the pandemic was a black swan event, right? Like, nobody could have seen it coming, right? Well, the yield curve inverted in August of 2019, and this historically accurate indicator signaled a potential recession was on its way in 2020. Now, at the time in August of 2019, our favorite central planner, Janet Yellen, she warned us not to worry about it, though. Now, regular viewers will notice that we covered this exact story of the 2019 yield curve inversion only a handful of weeks ago. So if you want to watch the full story of that, you can watch this video right here. Now, the short version of the story is literally the very next month, Janet Yellen told us not to worry about the yield curve inversion, and then there was a banking crisis in the overnight repo market as interest rates spiked to over 10%, the highest level since 2008. And then, in the last quarter of 2019, long before there was any news of COVID-19 in the United States, months before the WHO declared, the pandemic, the Fed pumped in $4.5 trillion into the repo markets to a number of unnamed banks. Now, the story becomes more interesting because at the time, Jerome Powell was adamant that the financial system was very healthy in late 2019 and that the money printing was not quantitative easing. Rather, it was just normal quarterly rebalancing, he said. Then, of course, the lockdowns provided the perfect excuse for central banks to print trillions in early 2020 and then give it out to the banks who desperately needed the bailout. Now, would you believe it that the yield curve was right again and our central planners were wrong? What a surprise. So what's the takeaway that we have here? Well, when the yield curve inverts, it's time to start paying attention. All right. Now, what is this mysterious yield curve that we're talking about? Well, let's watch this very short video clip here that does a really good job of explaining it.
Traders often look at the bond market for clues on how the U.S. economy will perform, specifically the yield curve.
given the yield curve inversion.
We inverted back in March.
Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
So what is the yield curve all about, and why is everybody talking about it? The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes. Usually the short-term rate is lower than the long-term one, but if you are lending money to the federal government, which is essentially what happens when you buy a Treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk. But sometimes this relationship changes. If the two rates start getting closer together, that's called a flattening yield curve. If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve. And the market is concerned about it.
All right, so that's not too complicated, right? Let's really unpack this for anyone who might have been lost in that video. If you're gonna lend the government money for a longer period of time, you'd expect to get compensated a higher interest repayment for the larger risk that you're taking. An upward sloping yield curve, which looks like the gray and yellow lines you can see on the screen, is what the yield curve looks like under normal circumstances and a sign that investors see strong and healthy economic growth ahead. An inversion occurs when the smart investors become fearful. And this scenario is highlighted by the blue line, which shows an inverted yield curve. Now, lenders are charging a higher rate for a 2-year loan as opposed to a 10-year loan, which doesn't make sense, right? Shouldn't you receive a higher interest rate on the 10-year loan because you're taking on more risk by lending the government or entity money for longer? Now, an inversion suggests that these lenders think more likely to repay a 10-year loan as opposed to the 2-year loan because they see short-term economic activity decreasing and a potential recession approaching. Now, businesses go bankrupt in a recession, and people's incomes generally decrease, of course, making it harder to repay loans. Investors will sell their shorter dated bonds, like their 3-month, 6-month, 2 years, etc., which causes yields to rise on the short end of the curve. Investors will also tend to hold on to their longer dated bonds, such as their 10, 20, 30-year bonds, because they suppose the government will survive the recession in the long term. Now, the rising short-end yields combined with the unchanged yields of the long-dated bonds leads to this flattening of the curve or an inversion. All right, so that's not too complicated, right? Now, this yield curve inversion is exactly what we've seen earlier this week for the first time since August of 2019. Now, notice how the curve can invert at different points along this curve and how the curve has flattened in the past 12 months. The yield curve first began to invert at the 5-year and the 10-year portion of the curve, and the yield on the 5-year bond is 2.43% and is now higher than the yield on the 10-year bond, which is at 2.34%. Now, the curve has also inverted on the 2 and the 10-year time frames, which is the most reliable inversion indicator investors like to look at. Now, this chart shows that every time the yield on the 2-year bonds are higher than the yields on the 10-year bond, we enter a recession in the months that follow. All right, so we've covered what it is, but why is it happening today in 2022, and what does it mean for the markets and, of course, for our own portfolios? Well, if we go back, we look at the previous 8 inversions, we can see stocks actually don't perform too badly. On average, the markets return about 2.1% higher 12 months following the yield curve inversion. Now, when looking at the previous 4 inversions, we can see that stocks peaked an average of 17.1 months after the inversion occurred. On average, 28.8% higher than when the inversion occurred. Now, the recession actually started an average of 21 months after the inversion occurred in these previous 4 examples. Okay, so yes, the yield curve is a great predictor of a recession, and it's just inverted this week, but the world isn't going to end tomorrow. All right. Now, while it's a good indicator, but on average, a recession is about 17 months away. But is this time different? Is this time different, especially when considering our outrageous debt situation? Well, more on that later, but first, let's take a look at what else happens around yield curve inversions. Now, another commonality throughout previous inversions is that our favorite central planners never acknowledge the risks of the inversion when they occur. So for example, back in 2008, Bernanke said this in response to the inversion that occurred in 2007. He said, quote, "I would not interpret the currently very flat yield curve as indicating a significant economic slowdown to come for several reasons," end quote. Now, of course, the worst recession in 50 years occurred basically right after he said that, all right, proving just how reliable the central planner's predictions are, which is the same thing that's happening again today, right? We can see the Washington Post telling us to not worry, don't worry about the yield curve inversion. Jeffrey Gundlach, aka the Bond King, had this to say in response to all the talking heads who were claiming we should ignore this yield curve inversion, like Yellen back in 2019. Anyway, you guys know that I could go on and on about central planners for hours, but getting back to the topic at hand, what's causing the inversion, and more importantly, are we headed for just another garden variety recession, or is this time different? Well, another reason for the curve inverting today is in 2022 is due to bond investors, aka the smart money. They begin to realize that with inflation at 40 years highs, they're sitting on a melting ice cube. And it's pretty obvious that if inflation is 7.9%, why would you want to hold a bond that's yielding only 2%? I mean, you're losing at least 6% of your money every year holding that bond. Now, until recently, investors appeared to believe that the Fed, when they said that inflation was temporary. But the combination of Jerome Powell retiring the word transitory, alongside the economic consequences associated with the sanctions imposed on Russia, have made the quote-unquote smart money realize that inflation could remain higher and for longer. Now, we can visualize this point better when looking at this chart of CPI inflation and the federal funds interest rates. Now, the shaded red area on the chart that I have on the screen measures the difference between the federal funds rate and the inflation number. Now, this is known as a, quote, negative real yield. This means that your cash and bonds are actually losing their purchasing power. Now, we haven't seen a negative yield this large for over 80 years. And this is when we were last at the end of an 80-year long-term debt cycle. And this was back in the 1940s. And the Fed was actively devaluing cash and bonds in order to deleverage the government's debt. And we'll go back to more on this shortly, but now that the Fed is posturing as if it wants to raise rates to close these negative yields, the Fed was engaging in $120 billion of quantitative easing in late 2021, and after 29 months of continuous QE since late 2019, to many people's surprise, they finally stopped. They stopped interfering in the markets on March 11th, which was just a couple of weeks ago. Now, the combination of central banks around the world slowing their buying of bonds alongside the sustained fears of inflation have caused the entire bond market to sell off aggressively. And bonds have had their worst start to the year in about 40 years. Now, the Bloomberg Global Bond Index has lost over $3 trillion in value at the same time of this recording. Now, when no one wants to buy government bonds, what happens? Well, it's easy. The government just creates more money and they buy them themselves. For example, out of the $30 trillion of debt the US government holds, the Federal Reserve has had to buy 25%, or about $5.5 trillion of that debt. Now, interesting side note, the Fed now also owns around 30% of the total mortgage-backed security market as well. Now, the Fed is having to buy more and more of the US debt because foreigners simply aren't buying as much debt as they have been. As a matter of fact, since 2014, treasuries being purchased by other sovereigns has remained flat, while bond issuance has gone parabolic. It's doubled, adding about another $14 trillion. And who is buying the rest? Oh yeah, it's the Federal Reserve, as well as the US banks and the US government pension funds, which of course are all backed up by the Fed. Now, central banks around the globe have been net sellers of US debt since the 2008 Great Financial Crash, and since 2014, they've bought 3 times more gold than US Treasuries. Now, the parabolic chart of the Fed assets is an indicator of foreigners that are slowly losing trust in the US dollar and our debt. When no one's buying a country's bonds, then people are losing faith in the government's bonds. All right? This is why central banks around the world are not only finishing their QE programs, but also raising rates as inflation persists. Now, the Fed claims that their aim, is to raise rates an additional 7 times in 2022, and as they aim to raise the federal funds rate to around 2.5%. Well, now the market believes that there's about a 60% chance of 9 rate hikes in 2022. And you know what they say about the consensus view of the market? It's always being wrong, right? We'll see, but raising rates with debt levels this high could prove to be very difficult. Okay, so now, for the billionaire Wall Street legend I referenced in the intro to this video, I'm talking about Stanley Druckenmiller. He's considered to be one of the greatest investors of all time, and in 2021, he came out and he shocked the world by blasting the actions of the Fed when he claimed it's, quote, mathematically impossible for the Fed to raise rates like they did back in 1970s when they had to combat inflation under Volcker. Now, Stanley Druckenmiller states that if the 10-year Treasury bonds interest rate rises to 4.9%, the U.S. government would have to be coming up with 30% of the U.S. GDP just to service the massive $30 trillion in debt that the U.S. currently has. Now, for context, that's $6.4 trillion per year. Tax receipts in the U.S. are currently at $3.8 trillion. So way short of that number, which means that they're going to have to print a lot more money. And if the federal funds rate is raised to 2.5%, that means the 10-year yield would be approximately 4.5%. So Druckenmiller claims that unless the Fed begins monetizing the debt again, the Fed isn't going to be able to raise rates very high. For example, the chart I have up now shows that every time the Fed's tried to hike interest rates in the past 50 years, it's caused some sort of financial crisis. So if the bond yields begin rising uncontrollably, and Druckenmiller's predictions become true, then the central bank will probably be forced to do something called yield curve control, or YCC. Now, we've seen this play out before in the 1940s during the conclusion of the previous long-term debt cycle. Now, there's a lot more that I could get over here, right? I wanted to dig into the history of this and more examples, including the US in 1940s and Japan, but I've already gone way too long. If you want another video on this, leave me a comment down below. But let's just tie all this together first, okay? The Fed is clearly in between a rock and a hard place. If Stanley Druckenmiller's prediction holds true, this current rate hiking cycle is going to be very interesting, if not impossible. And if we look at things logically, it appears as if the Fed will have to reverse course and implement something like yield curve control to peg rates low. However, if we look at things from a different perspective, let's ask ourselves the question. And of course, this assumes a bias of the Fed wanting to save the markets, but do they really? Now, of course, that's a whole nother topic. Let me know if we should discuss that as well. And of course, let me know what you think of this video in the comments down below. And do not miss your chance to come hang out with me live and in person, along with some of the best speakers in the world: Luke Grumman, George Gammon, Harry Danielle DiMartino Booth, Jeff Booth, Greg Foss, Lawrence Lippard, Robert Breedlove, Joe Brown from Heresy Financial, and so many more. Come hang out with us, meet us, make new friends, build new community, have a chance to have dinner with us, drinks, you name it. MarketDisruptorsLive.com, there's a link down below. As always, give me a thumbs up on this video if you like it. If you don't like the video, maybe it was scary, maybe it was too difficult to understand, that's okay. Give me a thumbs down, but at least tell me why in the comments down below. And that's what I got for you today. All right, to your success. I'm out.